Question 1. The risk matrix shows a moderate potential for client dissatisfaction if an annuity is recommended for unserendipitous investing without a thorough suitability assessment and clear disclosure of its limitations. Which of the following approaches best mitigates this risk while adhering to regulatory requirements for recommending life and health insurance products? Option A. Proceed with the annuity sale, focusing on its tax-deferred growth features, and advise the client to consult a separate financial advisor for investment strategy advice, without delving into the annuity's specific investment characteristics. Option B. Recommend the annuity based on the client's expressed desire for aggressive growth, highlighting its potential for higher returns compared to other available insurance products, and assuming the client understands the inherent risks. Option C. Emphasize the annuity's guaranteed income benefits and long-term security, while downplaying the surrender charges and the potential for market fluctuations impacting the accumulation phase, as the client is primarily seeking growth. Option D. Conduct a comprehensive needs analysis to understand the client's financial goals, risk tolerance, and time horizon, and then clearly explain how the annuity's features, benefits, and limitations align with these factors, specifically addressing the risks of using it for speculative investment. Correct answer is D. Conduct a comprehensive needs analysis to understand the client's financial goals, risk tolerance, and time horizon, and then clearly explain how the annuity's features, benefits, and limitations align with these factors, specifically addressing the risks of using it for speculative investment. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the client's stated investment goals with the inherent risks and regulatory obligations associated with annuity products, particularly when those products are being considered for purposes beyond their primary design. The core challenge lies in ensuring that the recommendation aligns with the client's best interests and complies with all applicable regulation, preventing the product from being used for unintended or unserendipitous investment strategies that could expose the client to undue risk or misrepresent the product's suitability. The correct approach involves a thorough assessment of the client's financial situation, risk tolerance, and objectives, followed by a clear explanation of how the annuity product's features, benefits, and limitations align with those objectives. This includes explicitly addressing the unserendipitous investing aspect by clarifying that the annuity is not designed as a speculative investment vehicle and outlining the potential downsides of using it in such a manner. This approach is correct because it prioritizes client suitability and transparency, adhering to regulatory mandates that require advisors to act in the client's best interest and to provide accurate and complete information about financial products. Specifically, regulations governing suitability and disclosure in insurance product sales will be paramount here, ensuring that the client understands the product's true nature and risks, not just its potential for growth. An incorrect approach would be to proceed with the sale based solely on the client's expressed desire for growth, without adequately probing their understanding of the annuity's limitations as an investment vehicle or the specific risks associated with using it for unserendipitous investing. This fails to meet the fiduciary duty or best interest standard, as it prioritizes the sale over the client's actual needs and understanding. Another incorrect approach would be to downplay or omit discussion of the annuity surrender charges, tax implications, or the fact that its primary purpose is retirement income, not active trading or speculative investment. This constitutes a failure of disclosure and misrepresentation, violating regulations that demand full and fair information. Finally, recommending an annuity solely because it offers a higher potential return than other available options, without a comprehensive suitability analysis, ignores the fundamental principle that product features must match client needs and risk profiles, not just a desire for aggressive growth. Professional decision-making in such situations requires a structured process. First, fully understand the client's stated and underlying needs and objectives. Second, thoroughly understand the product being recommended, including its design, limitations, and risks. Third, conduct a rigorous suitability assessment, ensuring a strong match between the client and the product. Fourth, engage in transparent and comprehensive communication with the client, addressing all potential concerns and clarifying any misunderstandings, especially regarding the product's intended use and associated risks. Question 2. The evaluation methodology shows that a client has established a health savings account (HSA) and has made regular pre-tax contributions. The client is now inquiring about the tax treatment of funds withdrawn from the HSA to cover eligible medical expenses. Which of the following accurately reflects the tax implications for the client? Option A. Contributions to the HSA are treated as a general itemized deduction, not tied to a high-deductible health plan. Option B. Withdrawals used for qualified medical expenses are tax-free. Option C. All earnings within the HSA are taxed annually, regardless of withdrawals. Option D. Withdrawals used for qualified medical expenses are taxed as ordinary income. The correct answer is B. Withdrawals used for qualified medical expenses are tax-free. Explanation. The evaluation methodology shows that understanding the tax implications of health savings accounts, HSA, is crucial for financial professionals advising clients. This scenario is professionally challenging because it requires not just knowledge of HSA mechanics, but also a precise application of tax law to a client's specific situation, ensuring compliance and maximizing client benefit. Misinterpreting these rules can lead to significant tax liabilities for the client and potential professional repercussions. The correct approach involves accurately identifying and applying the tax treatment for HSA contributions, qualified medical expenses, and distributions as stipulated by the relevant tax code. This means recognizing that contributions are tax-deductible, earnings grow tax-free, and qualified distributions for medical expenses are also tax-free. This aligns directly with the legislative intent of HSAs to encourage healthcare savings and provide tax advantages for individuals with high-deductible health plans. An incorrect approach that suggests taxing distributions for non-qualified expenses as ordinary income, with a potential penalty, fails to acknowledge the specific tax treatment outlined for HSAs. This approach would lead to an incorrect tax outcome for the client, as the law clearly defines how non-qualified distributions are treated. Another incorrect approach that proposes taxing all HSA earnings annually, regardless of distribution, directly contradicts the tax-free growth provision of HSAs. This would negate one of the primary benefits of an HSA and result in an inaccurate tax assessment. Furthermore, an incorrect approach that suggests treating HSA contributions as a general deduction without regard to the high-deductible health plan requirement overlooks a fundamental eligibility criterion for HSAs. This would lead to improper advice regarding eligibility and tax deductibility. The professional reasoning process for similar situations should involve 1. Confirming client eligibility for an HSA based on their health plan coverage. 2. Understanding the specific tax treatment of contributions, earnings, and distributions under the applicable tax laws. 3. Differentiating between qualified and non-qualified distributions and their respective tax consequences. 4. Consulting official tax guidance and regulations when in doubt to ensure accurate client advice and compliance. Question 3. Research into the tax treatment of cash value accumulation in life insurance policies reveals varying client assumptions. Which of the following approaches best aligns with the regulatory framework governing the taxation of life insurance contracts in the United States? Option A. Inform clients that cash value growth is tax-deferred and explain that withdrawals are typically treated as a return of premium cost basis first, then any gains above the cost basis being taxable income upon withdrawal or surrender. Option B. Advise clients that all cash value accumulation within a life insurance policy is entirely tax-free, regardless of how or when the funds are accessed. Option C. Recommend that clients withdraw funds from their cash value as needed without concern for tax reporting, as long as total withdrawals do not exceed the total premiums paid. Option D. Suggests surrendering a policy with appreciated cash value to access funds, without mentioning the potential tax liability on the gains realized from the surrender. The correct answer is A. Inform clients that cash value growth is tax-deferred and explain that withdrawals are typically treated as a return of premium cost basis first, with any gains above the cost basis being taxable income upon withdrawal or surrender. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of tax laws as they apply to life insurance products, specifically the accumulation of cash value. Advisors must navigate the potential for unintended tax consequences for their clients, balancing the benefits of tax-deferred growth with the rules governing withdrawals and surrenders. The complexity arises from the fact that, while cash value growth is generally tax-deferred, the timing and method of accessing these funds can trigger taxable events. Professional judgment is crucial to ensure clients are fully informed and that recommendations align with their financial goals and tax situations. The correct approach involves proactively educating clients about the tax implications of cash value accumulation, including the rules for cost-basis recovery and the taxation of gains when withdrawals or surrenders occur. This approach prioritizes client understanding and compliance with tax regulations, such as those outlined in the Internal Revenue Code, IRC sections governing life insurance contracts. Specifically, it acknowledges that withdrawals are generally treated as a return of premium cost basis, first, with any excess being considered taxable gain. Surrenders also follow this principle, with the net surrender value being compared to the cost basis. This proactive and informative stance ensures clients can make informed decisions about their policies and avoid unexpected tax liabilities. An incorrect approach involves advising clients that all cash value accumulation is entirely tax-free under all circumstances. This fails to acknowledge the distinction between tax-deferred growth and tax-free access, and it directly contradicts the IRC's provisions for taxing gains upon withdrawal or surrender beyond the cost basis. This misrepresentation can lead to significant tax penalties and financial distress for the client. Another incorrect approach is to suggest that clients can withdraw funds indefinitely without any tax reporting requirements, as long as the total withdrawals do not exceed the initial premium paid. While withdrawals up to the cost basis are not taxed as income, they still reduce the policy's cost basis for future calculations, and the IRS requires proper reporting of policy transactions. This approach overlooks the importance of accurate record keeping and the potential for future tax implications if gains are eventually realized. A further incorrect approach is to recommend that clients surrender their policies solely to access the cash value, without discussing the tax consequences of surrendering a policy that has appreciated in value. A surrender is treated as a taxable event, where the excess of the surrender value over the cost basis is taxed as ordinary income. Failing to inform the client of this potential tax liability is a significant ethical and regulatory failure. The professional decision-making process for similar situations should involve a thorough review of the client's policy, a clear understanding of the relevant tax laws, primarily IRC sections 72 and 7702, and open communication with the client. Advisors should always err on the side of providing comprehensive information, even if it means explaining potentially unfavorable tax outcomes. Consulting with tax professionals when necessary is also a critical component of responsible advice. Question 4. To address the challenge of identifying and reporting potential money laundering activities within the life and health insurance sector, which of the following actions best demonstrates adherence to anti-money laundering, AML, regulations and professional best practices when a long-standing client, whose financial profile has remained consistent, suddenly engages in a transaction significantly larger and more complex than their usual pattern, with the stated purpose being an investment in an overseas property? Option A. Conduct enhanced due diligence on the transaction, including verifying the source of funds for the larger amount, understanding the specific details of the overseas property investment, and documenting all findings before deciding on further action, potentially including escalation or SAR filing. Option B. Proceed with the transaction as requested, assuming the client has legitimate reasons for the sudden change in financial activity, given their long-standing relationship and consistent past behavior. Option C. Inform the client directly that their transaction is flagged as suspicious due to its size and international nature, and request detailed explanations before processing. Option D. Immediately file a suspicious activity report (SAR) with the relevant financial intelligence unit based on the unusual transaction size and international component, without further inquiry. The correct answer is D. Immediately file a suspicious activity report (SAR) with the relevant financial intelligence unit based on the unusual transaction size and international component, without further inquiry. Explanation. This scenario presents a professional challenge because anti-money laundering, AML, regulations require insurance professionals to be vigilant in identifying and reporting suspicious activities, balancing customer service with regulatory compliance. The core difficulty lies in discerning genuine customer transactions from potential illicit financial flows without causing undue disruption or suspicion. Careful judgment is required to avoid both overlooking red flags and unfairly scrutinizing legitimate business. The correct approach involves a thorough understanding of customer due diligence (CDD) requirements as mandated by the relevant AML legislation. This includes verifying customer identity, understanding the nature and purpose of the business relationship, and ongoing monitoring of transactions. When a transaction appears unusual or inconsistent with the customer's profile, the professional must escalate it for further investigation according to internal procedures and regulatory guidelines, which may include filing a suspicious activity report (SAR), if warranted. This approach upholds the regulatory obligation to prevent financial crime while maintaining professional integrity. An incorrect approach would be to ignore the unusual transaction simply because the customer is a long-standing client. This failure neglects the ongoing monitoring aspect of AML regulations and the principle that even established relationships can be exploited for illicit purposes. It risks enabling money laundering and exposes the firm to significant regulatory penalties. Another incorrect approach is to immediately terminate the business relationship and report the customer without proper investigation or escalation. While vigilance is crucial, an immediate, unsubstantiated accusation can be damaging to the customer and may not align with the regulatory requirement to report suspicious activity, which implies a degree of certainty or strong indication of illicit intent based on evidence. This approach can lead to reputational damage and potential legal repercussions if the suspicion proves unfounded. A further incorrect approach is to accept the transaction at face value due to the customer's perceived social standing or influence. This is a critical ethical and regulatory failure. AML regulations apply universally, and no individual or entity is exempt from scrutiny based on their status. This approach demonstrates a lack of professional integrity and a disregard for the law, potentially making the professional complicit in financial crime. The professional decision-making process for similar situations should involve a systematic evaluation of the transaction against established AML policies and procedures. This includes 1. Assessing the transaction's consistency with the customer's known profile and risk assessment. 2. Identifying any deviations or unusual patterns. 3. Consulting internal AML compliance officers or designated personnel for guidance. And 4. Following established protocols for reporting or escalating suspicious activity, ensuring all actions are documented. Question 5. Analysis of a life insurance claim for critical illness benefit reveals that the claimant has provided medical documentation from their treating physician. However, the investigator suspects the illness may have been pre-existing, a condition excluded by the policy. The investigator has access to public records and can engage a private investigator for surveillance. What is the most appropriate course of action for the insurance investigator? Option A. Inform the claimant directly that their claim is likely to be denied due to suspected pre-existing conditions, and ask them to provide proof of non-existence of such conditions. Option B. Review the claimant's provided medical documentation. Request authorization from the claimant to obtain relevant medical records from other healthcare providers, and consult public records for any relevant information that supports or refutes the suspicion, while maintaining strict confidentiality. Option C. Request additional medical records directly from the claimant's employer's health insurance provider, without the claimant's explicit consent, to cross-reference medical history. Option D. Immediately engage a private investigator to conduct covert surveillance on the claimant's daily activities to gather evidence of pre-existing conditions. The correct answer is D. Immediately engage a private investigator to conduct covert surveillance on the claimant's daily activities to gather evidence of pre-existing conditions. Explanation. This scenario presents a professionally challenging situation because it requires an insurance investigator to balance the need for thoroughness in an investigation with the imperative to act ethically and within regulatory boundaries. The investigator must gather sufficient evidence to determine the validity of a claim, while respecting the privacy of the claimant and avoiding any actions that could be construed as harassment or overreach. The potential for misinterpretation of evidence or the claimant's actions adds another layer of complexity, demanding careful judgment and adherence to established protocols. The correct approach involves a systematic and documented investigation that prioritizes gathering objective evidence through permissible means. This includes reviewing policy documents, interviewing relevant parties, with consent where required, and obtaining public records. The investigator must maintain a neutral stance, focusing on facts rather than assumptions. This approach is ethically sound and legally compliant because it respects the claimant's rights, adheres to the principles of fair investigation, and ensures that any conclusions are based on verifiable information, thereby upholding the integrity of the insurance process and complying with regulations governing claims investigation and data privacy. An incorrect approach would be to engage in intrusive surveillance without clear justification or proper authorization. This could involve actions like unauthorized entry onto private property or extensive monitoring of personal activities beyond what is reasonably necessary to verify the claim. Such actions violate privacy rights and could lead to legal repercussions for the investigator and the insurance company, as well as breaches of ethical conduct and potential violations of data protection laws. Another incorrect approach would be to rely solely on hearsay or unsubstantiated allegations without independent verification. This could involve accepting information from unverified sources without cross-referencing or seeking corroborating evidence. This method is professionally unacceptable because it risks making decisions based on inaccurate or biased information, which can lead to an unfair denial or approval of a claim and damage the reputation of the insurer. It fails to meet the standard of due diligence required in claims investigation. A further incorrect approach would be to prematurely communicate findings or suspicions to parties not directly involved in the investigation or to the claimant in a manner that could be perceived as accusatory before all facts are gathered. This premature disclosure can prejudice the investigation, create unnecessary distress for the claimant, and potentially violate confidentiality agreements or privacy regulations. Professional decision-making in such situations requires a methodical approach. First, thoroughly understand the policy terms and conditions relevant to the claim. Second, identify the specific information needed to validate or invalidate the claim. Third, plan an investigation strategy that utilizes legal and ethical methods to obtain that information. Fourth, document all investigative steps and findings meticulously. And finally, base the claim decision solely on the gathered evidence and applicable policy provisions. Question 6. The investigation demonstrates that an underwriter is reviewing an application for a life insurance policy. The applicant has provided a detailed personal history, but the underwriter requires additional medical information to accurately assess the risk. Which of the following represents the most compliant and ethically sound approach to gathering this necessary information, adhering strictly to the regulatory framework for the certified professional life and health insurance CPLHI exam? Option A. The underwriter requests a detailed medical history from the applicant's spouse, assuming this is a reliable source of information and that spousal consent is implied. Option B. The underwriter contacts the applicant's employer to inquire about the applicant's general health status and any past medical leaves of absence, without obtaining specific consent for this inquiry. Option C. The underwriter requests a comprehensive medical examination from a licensed physician, obtains the applicant's signed authorization for the examination, and then requests an attending physician statement, APS, directly from the applicant's primary care physician, also with a signed authorization. The underwriter also checks the Medical Information Bureau, MIB, for any prior coded medical information, adhering to MIB reporting guidelines. Option D. The underwriter accesses the applicant's medical records directly from the hospital's electronic health record system, using publicly available information, believing this is a permissible way to gather underwriting data. The correct answer is C. The underwriter requests a comprehensive medical examination from a licensed physician, obtains the applicant's signed authorization for the examination, and then requests an attending physician statement, APS, directly from the applicant's primary care physician, also with a signed authorization. The underwriter also checks the Medical Information Bureau, MIB, for any prior coded medical information, adhering to MIB reporting guidelines. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need for accurate risk assessment with the imperative to comply with strict privacy regulations and ethical guidelines concerning the use of applicant information. The core tension lies in obtaining sufficient underwriting information without infringing upon an applicant's rights or misusing sensitive data. Careful judgment is required to ensure that all information sources are legitimate, relevant, and handled in accordance with established legal and ethical frameworks. The correct approach involves a systematic and compliant process for gathering underwriting information. This includes obtaining the applicant's explicit consent for each type of information sought, ensuring that medical examinations are conducted by qualified professionals, and that attending physician statements, APs, are requested directly from the physician with proper authorization. The Medical Information Bureau, MIB, is a crucial resource, but its use is governed by specific rules regarding disclosure and permissible uses. This approach is correct because it adheres to the principle of informed consent, respects privacy, and utilizes authorized channels for information gathering, thereby fulfilling regulatory requirements and ethical obligations. An incorrect approach would be to bypass the need for explicit consent when requesting medical records. This failure directly violates privacy laws and ethical standards that mandate an applicant's authorization before their protected health information can be shared. Another incorrect approach is to rely solely on information obtained from sources that are not authorized for underwriting purposes, or to misrepresent the purpose for which information is being collected. This constitutes a breach of trust and can lead to legal repercussions and damage to the insurer's reputation. Furthermore, misinterpreting or misusing information from the MIB, such as using it for discriminatory purposes or failing to follow its reporting guidelines, is a significant regulatory violation. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Understanding the specific legal and regulatory requirements governing underwriting information in the relevant jurisdiction. 2. Always obtaining explicit, informed consent from the applicant for any information that requires it. 3. Verifying the legitimacy and authorization of all information sources. 4. Ensuring that all collected information is relevant to the underwriting decision and is handled with appropriate confidentiality. 5. Regularly reviewing and updating internal policies and procedures to align with evolving regulations and best practices. Question 7. During the evaluation of a prospective client's insurance needs, a life and health insurance agent identifies two policy options. Policy A offers a significantly higher commission to the agent but may be more complex and potentially exceed the client's immediate budget. Policy B is a more straightforward option that aligns better with the client's stated financial comfort level and immediate needs, but offers a lower commission to the agent. The agent has conducted a preliminary needs assessment. Which of the following approaches best upholds the agent's ethical and regulatory obligations? Option A. Recommend policy A, disclosing the higher commission to the client, and then advising them that policy B is also an option, but highlighting the commission difference to encourage the selection of policy A. Option B. Avoid discussing the specific policy options in detail, and instead suggest the client take more time to consider their needs independently. Option C. Recommend policy A, disclosing the higher commission to the client and explaining the potential benefits of its broader coverage, while downplaying the client's budget concerns. Option D. Recommend policy B to the client, explaining that while it offers a lower commission, it is the most suitable option based on their stated needs and financial comfort. The correct answer is D. Recommend policy B to the client, explaining that while it offers a lower commission, it is the most suitable option based on their stated needs and financial comfort. Explanation. This scenario is professionally challenging because it pits the agent's personal financial gain against the client's best interests and the integrity of the insurance process. The agent must navigate a situation where a potentially lucrative commission could be earned by recommending a product that may not be the most suitable for the client's needs, creating a conflict of interest. Careful judgment is required to uphold ethical principles and regulatory compliance. The correct approach involves prioritizing the client's needs and interests above all else, even if it means a lower commission for the agent. This aligns with the fundamental ethical principle of acting in the client's best interest and adhering to regulatory requirements that mandate fair dealing and suitability. Specifically, regulations governing the sale of life and health insurance products typically require agents to assess a client's financial situation, needs, and objectives, and to recommend products that are suitable for that client. Recommending a policy solely based on commission potential, without regard for suitability, violates these principles and can lead to regulatory sanctions, reputational damage, and harm to the client. An incorrect approach that involves recommending the higher commission policy without a thorough needs analysis demonstrates a failure to uphold the duty of care and suitability. This prioritizes the agent's financial benefit over the client's well-being, which is a direct violation of ethical standards and likely contravenes specific regulations requiring suitability assessments. Another incorrect approach, which is to disclose the commission structure but still push for the higher commission policy, is also professionally unacceptable. While disclosure is a component of transparency, it does not absolve the agent of the responsibility to recommend a suitable product. The client may not fully understand the implications of the commission structure or be able to make an informed decision when presented with a product that is not truly in their best interest. This approach still prioritizes the agent's gain and fails to meet the core ethical and regulatory obligation of suitability. A further incorrect approach, which is to avoid discussing the policy options altogether to sidestep the ethical dilemma, is also a failure. This passive approach does not serve the client's needs and avoids the agent's responsibility to provide professional advice and guidance. It can leave the client uninformed and unable to make necessary insurance decisions. The professional decision-making process for similar situations should involve a clear framework. 1. Identify the client's needs, financial situation, and objectives. 2. Assess available products for suitability based on the client's profile. 3. Prioritize the client's best interests and suitability over personal gain. 4. If a conflict of interest arises, e.g., higher commission on a less suitable product, disclose the conflict and the implications clearly to the client but still recommend the most suitable option. 5. Document the needs analysis, recommendations, and client decisions thoroughly. 6. If unsure, seek guidance from a supervisor or compliance department. Question 8. Cost-benefit analysis shows that while life insurance death benefits are generally income tax-free to beneficiaries, a critical factor in determining their estate tax liability is the insured's retained incidence of ownership at the time of death. Considering this, which of the following approaches best aligns with prudent estate tax planning for life insurance proceeds? Option A. Emphasize that the income tax-free nature of death benefits means they are also free from estate tax, and no further planning is needed. Option B. Guide the client to review the current ownership structure and retained incidence of ownership to accurately assess potential estate tax inclusion and plan accordingly. Option C. Advise the client that as long as the policy is owned by someone other than the insured, the death benefit will always be excluded from the insured's gross estate for estate tax purposes. Option D. Recommend transferring ownership of the policy to a beneficiary immediately before the insured's death to ensure exclusion from the estate. The correct answer is C. Advise the client that as long as the policy is owned by someone other than the insured, the death benefit will always be excluded from the insured's gross estate for estate tax purposes. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an advisor to navigate the complex intersection of life insurance policy ownership, estate planning, and the specific tax implications of life insurance proceeds within the relevant jurisdiction. Misunderstanding or misapplying estate tax laws can lead to significant financial burdens for beneficiaries and potential professional liability for the advisor. The advisor must balance the client's desire to provide for beneficiaries with the legal and tax obligations associated with their estate. Correct approach analysis. The correct approach involves a thorough understanding of how life insurance proceeds are treated for estate tax purposes based on the insured's ownership and control at the time of death. Specifically, if the insured retained any incidence of ownership, e.g., the right to change beneficiaries, surrender the policy, borrow against the policy value, or pledge the policy as collateral, the death benefit will generally be included in their gross estate for federal estate tax calculations. This approach is correct because it aligns with established estate tax principles and regulatory guidance, ensuring that the client's estate plan accurately reflects potential tax liabilities and allows for appropriate planning to mitigate them, such as through irrevocable life insurance trusts or gifting strategies. Incorrect approach is analysis. One incorrect approach is to assume that life insurance death benefits are always excludable from the insured's gross estate, regardless of ownership. This overlooks the critical incidence of ownership test, a fundamental principle in estate taxation of life insurance. Failing to consider this can lead to underestimation of estate tax liability and inadequate planning. Another incorrect approach is to focus solely on the income tax treatment of life insurance, assuming that because death benefits are generally income tax-free to the beneficiary, they are also free from estate tax. This conflates two distinct tax regimes and ignores the specific rules governing estate taxation. A third incorrect approach is to advise the client to transfer ownership of the policy to a beneficiary shortly before death, without considering the look-back periods or other anti-avoidance rules that might still include the policy in the estate if the transfer was made in contemplation of death, or without full relinquishment of incidents of ownership. This can lead to unintended inclusion in the estate and potential tax penalties. Professional reasoning. Professionals should adopt a systematic approach. First, identify the client's objectives for the life insurance proceeds. Second, ascertain the current ownership structure and the insured's retained incidents of ownership. Third, consult the relevant jurisdiction's estate tax laws and IRS guidance, or equivalent in other jurisdictions, to determine the taxability of the death benefit. Fourth, explore estate planning strategies that align with the client's objectives and tax laws, such as irrevocable trusts, policy ownership restructuring, or gifting. Finally, clearly communicate the tax implications and planning options to the client, ensuring they make informed decisions. Question 9. Cost-benefit analysis shows that a small consulting firm is concerned about potential lawsuits from clients alleging negligence in their advice, which could lead to significant financial damages. The firm has limited cash reserves. Which of the following approaches best facilitates the transfer of this specific business risk? Option A. Recommend the firm self-insure by establishing a dedicated reserve fund. Option B. Suggest the firm obtain a professional liability, errors and omissions insurance policy. Option C. Advise the firm to purchase a workers' compensation insurance policy. Option D. Recommend a comprehensive general liability insurance policy. The correct answer is D. Recommend a comprehensive general liability insurance policy. Explanation. Scenario analysis. This scenario presents a professional challenge where an insurance agent must advise a client on the most suitable risk transfer mechanism for a specific business exposure. The challenge lies in accurately assessing the client's risk appetite, the nature of the potential loss, and the cost-effectiveness of different insurance solutions, all while adhering to regulatory requirements for suitability and disclosure. The agent must balance the client's financial interest with the principles of sound risk management and the ethical obligation to provide unbiased advice. Correct approach analysis. The correct approach involves recommending a comprehensive general liability insurance policy. This is the most appropriate risk transfer mechanism, because it directly addresses the client's stated concern of potential third-party claims arising from their business operations. General liability insurance is designed to cover bodily injury, property damage, and personal and advertising injury, claims that a business may become legally obligated to pay. This aligns with the core principle of risk transfer, where the financial burden of a covered loss is shifted from the insured to the insurer. Regulatory justification stems from the agent's duty to recommend products that are suitable for the client's needs and to act in the client's best interest, as mandated by insurance laws and ethical codes governing licensed agents. Incorrect approaches analysis. Recommending a workers' compensation policy is incorrect because it specifically covers employee injuries and illnesses sustained in the course of employment. While important for businesses with employees, it does not address the client's primary concern of third-party claims arising from their business operations. This would be a misrepresentation of the policy's purpose and a failure to meet the client's stated risk transfer needs, violating suitability regulations. Suggesting a professional liability, errors and omissions policy is incorrect because this type of insurance protects businesses against claims of negligence, errors, or omissions in the performance of their professional services. Client's concern is about general business operations, not specifically professional service delivery, making this an inappropriate and potentially misleading recommendation. This fails to address the core risk and could lead to regulatory scrutiny for recommending an unsuitable product. Advising the client to self-insure by setting aside funds is incorrect as a primary recommendation for this specific exposure. While self-insurance can be a valid risk management strategy, it is generally suitable for predictable, low-frequency, low-severity risks, or for very large organizations with significant financial capacity. For small business facing potentially catastrophic third-party claims, self-insuring would expose them to unacceptable financial risk, failing the duty to recommend appropriate risk transfer mechanisms that protect against significant financial loss. This could be seen as a failure to act in the client's best interest and a violation of prudent risk management advice. Professional reasoning. Professionals should employ a structured approach to client advice. This involves thoroughly understanding the client's business operations, identifying potential risks, assessing the client's risk tolerance and financial capacity, and then matching these factors with appropriate risk management strategies and insurance products. The process should always prioritize the client's best interests, ensuring transparency and full disclosure of policy coverage, limitations, and costs. Regulatory compliance and ethical conduct are paramount, requiring agents to recommend only suitable products and to avoid any misrepresentation or omission of material facts. Question 10. Comparative studies suggest that the foundational elements of a valid insurance contract are critical for its enforceability. An applicant for a life insurance policy submits a completed application form along with the initial premium payment. The insurance company's underwriting department reviews the application and approves it, issuing a policy document to the applicant. Which of the following best describes the fulfillment of the essential elements of a valid contract in this scenario? Option A. The applicant's intent to purchase insurance is the offer, the insurer's underwriting process is the acceptance, and the policy's death benefit is the sole consideration. Option B. The applicant's submission of the application and premium constitutes the offer, and the insurer's approval and issuance of the policy represent the acceptance, with consideration being the exchange of the premium for the promise of coverage. Option C. The application form itself is the acceptance, the premium payment is the offer, and the insurer's approval signifies the consideration. Option D. The insurer's policy document is the offer, and the applicant's payment of the premium is the acceptance, with the applicant's age being the primary consideration. The correct answer is B. The applicant's submission of the application and premium constitutes the offer, and the insurer's approval and issuance of the policy represent the acceptance, with consideration being the exchange of the premium for the promise of coverage. Explanation. This scenario is professionally challenging because it requires the insurance professional to identify the fundamental elements of a valid contract within a practical, client-facing situation. Misinterpreting these elements can lead to the issuance of invalid policies, creating significant legal and financial liabilities for both the insurer and the insured, and damaging the professional's reputation. Careful judgment is required to ensure all contractual prerequisites are met to uphold the integrity of the insurance agreement. The correct approach involves recognizing that a valid insurance contract, under the specified regulatory framework for the Certified Professional Life and Health Insurance (CPLHI) exam, requires the presence of offer, acceptance, consideration, competent parties, and a legal purpose. Specifically, the scenario highlights the need for a clear offer, the policy terms and premium, unequivocal acceptance, the insurer agreeing to provide coverage, and consideration, the premium paid by the applicant and the promise of indemnity by the insurer. Competent parties, individuals of legal age and sound mind, and a legal purpose, not for illegal activities, are also essential. An incorrect approach would be to overlook the necessity of clear acceptance. For instance, assuming acceptance based solely on the submission of an application and premium without formal insurer approval would render the contract voidable. This fails to meet the legal requirement of mutual assent. Another incorrect approach would be to proceed with a policy for an applicant who clearly lacks the mental capacity to understand the terms, violating the competent party's requirement and the principle of informed consent. Furthermore, issuing a policy for an illegal purpose, such as to cover a fraudulent scheme, directly contravenes the legal purpose element, making the contract unenforceable and unethical. Professionals should employ a decision-making framework that systematically verifies each element of a valid contract. This involves 1. Confirming a clear offer is presented and understood by the applicant. 2. Ensuring there is a clear and communicated acceptance by the insurer. 3. Verifying that valid consideration premium for coverage is exchanged. 4. Ascertaining that all parties involved are legally competent. 5. Confirming that the purpose of the insurance is legal and ethical. This structured approach, grounded in regulatory requirements, ensures that all contracts are valid and enforceable, protecting all parties involved. Question 11. System analysis indicates that a life insurance policyholder has submitted a claim for a medical condition. To process this claim efficiently, the insurance company needs to obtain detailed medical records directly from the policyholder's treating physician. The policyholder has not yet provided explicit written consent for the release of these specific records to the insurer. Which of the following actions represents the most appropriate and compliant approach for the insurance company? Option A. Proceed with processing the claim based on the information already provided by the policyholder, without seeking further medical records from the physician. Option B. Request only a summary of the medical condition from the treating physician, omitting specific details to minimize privacy concerns. Option C. Contact the policyholder to obtain a signed, written authorization, specifically permitting the release of their medical records from the treating physician to the insurance company for claim processing. Option D. Directly request the medical records from the treating physician, explaining that the information is necessary for claim processing. The correct answer is D. Directly request the medical records from the treating physician, explaining that the information is necessary for claim processing. Explanation. This scenario is professionally challenging because it requires balancing the immediate need for information to process a claim with the stringent privacy obligations imposed by HIPAA. A life and health insurance professional must navigate the complex rules surrounding protected health information, FI, to ensure compliance while still fulfilling their duties to the policyholder and the insurer. The core challenge lies in understanding what information can be shared, with whom, and under what circumstances, without violating patient privacy rights. The correct approach involves obtaining a valid authorization from the policyholder before disclosing any PHI to a third party, even if that third party is a healthcare provider involved in the claim. This aligns directly with HIPAA privacy rule, which mandates that covered entities, like insurance companies, must obtain patient authorization for most uses and disclosures of PHI. This authorization must be specific, in writing, and clearly outline the information to be disclosed, the purpose of the disclosure, and the recipient. This ensures the policyholder is informed and consents to the sharing of their sensitive health data, upholding both legal requirements and ethical principles of patient confidentiality. An incorrect approach would be to assume that because the information is for a claim, it can be freely shared with the healthcare provider. This violates HIPAA by disclosing PHI without the required authorization. Another incorrect approach would be to only partially disclose the information, believing this mitigates the risk. However, any disclosure of PHI without proper authorization or a specific exception under HIPAA is a violation. Finally, delaying the claim processing indefinitely due to an overzealous interpretation of privacy rules, without attempting to obtain the necessary authorization, would be professionally negligent and detrimental to the policyholder. Professional decision-making in such situations requires a systematic approach. First, identify the type of information requested and its relation to PHI. Second, consult the relevant HIPAA provisions to determine if a disclosure exception applies or if authorization is required. Third, if authorization is needed, initiate the process to obtain it from the policyholder promptly and clearly. Fourth, document all communications and actions taken regarding PHI disclosure. This structured process ensures that privacy is protected while operational needs are met in a compliant manner. Question 12. Investigation of the process by which an insurance company introduces modifications to its existing life insurance policy forms for use in a particular state, considering the regulatory framework for policy form filing and approval. Option A. The insurer may begin using the modified policy form immediately and notify the Department of Insurance of the changes within 30 days of implementation. Option B. The insurer should rely on industry standard practices for policy form modifications, assuming that if it is common practice, it is acceptable. Option C. The insurer can implement minor wording changes to the policy form without prior submission, as long as the core benefits remain the same. Option D. The insurer must submit the modified policy form to the state's Department of Insurance for review and approval prior to its use in the market. The correct answer is D. The insurer must submit the modified policy form to the state's Department of Insurance for review and approval prior to its use in the market. Explanation. This scenario presents a professional challenge because insurance policy forms are the foundational documents that define the terms, conditions, benefits, and exclusions of coverage. Inaccurate or non-compliant policy forms can lead to significant financial liabilities for the insurer, consumer dissatisfaction, regulatory penalties, and reputational damage. The insurer's obligation to file policy forms with the relevant state insurance department and obtain approval before use is a critical regulatory requirement designed to protect policyholders and ensure market stability. Navigating the nuances of state-specific filing requirements, understanding what constitutes a material change requiring refiling, and adhering to approval timelines are essential for compliance. The correct approach involves a thorough review of the proposed policy form changes against the specific filing requirements of the state where the policy will be marketed. This includes identifying whether the changes are considered material and thus necessitate a new filing and approval process. The insurer must then submit the revised form to the state insurance department, providing all required documentation and information, and await official approval before issuing policies with the new form. This proactive and compliant approach ensures that the policy form meets all statutory and regulatory standards, safeguarding both the insurer and the consumer. This aligns with the regulatory mandate to ensure policy forms are fair, reasonable, and not misleading, as well as the ethical responsibility to conduct business with integrity and in accordance with the law. An incorrect approach would be to implement changes to an existing policy form and begin using it in the market without first submitting it for regulatory review and approval. This bypasses the essential oversight mechanism designed to protect consumers and uphold regulatory standards. Such an action constitutes a direct violation of policy form filing laws, which typically mandate prior approval for all new or substantially modified policy forms. This failure exposes the insurer to significant penalties, including fines, cease and desist orders, and potential revocation of its license to operate in that jurisdiction. It also creates a risk of invalidating coverage for policyholders who rely on the terms of a non-approved form. Another incorrect approach would be to assume that minor wording changes do not require refiling, even if they alter the scope of coverage or introduce new exclusions. While some jurisdictions may have de minimis exceptions for purely clerical errors, any change that impacts the rights or obligations of the policyholder or the insurer is generally considered material and subject to the filing and approval process. Relying on such assumptions without consulting the specific state's regulations or seeking clarification from the Department of Insurance is a risky and non-compliant practice. This demonstrates a lack of due diligence and a disregard for the regulatory framework. A third incorrect approach would be to file a policy form with incomplete or misleading information, or to misrepresent the nature of the changes made. Regulatory bodies rely on accurate and complete submissions to perform their review effectively. Providing false or incomplete information undermines the integrity of the filing process and can lead to the approval of a non-compliant form, or conversely, the rejection of a potentially valid form due to a lack of trust. This not only violates regulatory requirements for accurate submissions, but also constitutes an ethical breach of honesty and transparency. The professional decision-making process for similar situations should always begin with a thorough understanding of the applicable state insurance laws and regulations governing policy form filings. This involves consulting the relevant statutes, administrative rules, and any guidance issued by the State Department of Insurance. When in doubt about the materiality of a change or the specific filing requirements, it is prudent to seek clarification directly from the regulatory body or consult with legal counsel specializing in insurance law. A proactive approach that prioritizes compliance and consumer protection, even if it involves additional time and resources, is always the most professionally sound and ethically responsible course of action. Question 13. The audit findings indicate that a client, who is the sole owner and beneficiary of a health savings account, HSA, has inquired about using their HSA funds to pay for a new, non-essential luxury item for their spouse, arguing that it would indirectly benefit their overall well-being and reduce stress. As a certified professional, life and health insurance advisor, what is the most ethically and regulatorily appropriate course of action? Option A. Recommend that the client withdraw the funds and pay income tax and the 20% penalty, as this is the only way to access funds for non-qualified personal purchases. Option B. Inform the client that the decision is entirely theirs and that the advisor cannot provide guidance on the use of HSA funds, leaving the client to research IRS regulations independently. Option C. Advise the client that HSA funds are strictly for qualified medical expenses as defined by the IRS and explain the tax implications and penalties for non-qualified withdrawals, while offering to discuss eligible medical expenses. Option D. Suggest the client use the HSA funds for the luxury item, explaining that the IRS has broad interpretations of medical expenses and that personal well-being can be considered a factor. The correct answer is C. Advise the client that HSA funds are strictly for qualified medical expenses as defined by the IRS, and explain the tax implications and penalties for non-qualified withdrawals, while offering to discuss eligible medical expenses. Explanation: the audit findings indicate a potential ethical lapse concerning the administration of health savings accounts, HSA. This scenario is professionally challenging because it requires balancing the fiduciary duty to the client with the need to adhere strictly to complex and evolving HSA regulations. The advisor must navigate the gray areas of permissible advice and avoid actions that could be construed as facilitating improper use of HSA funds, which carries significant legal and ethical ramifications for both the client and the advisor. The correct approach involves advising the client on the permissible uses of HSA funds as defined by IRS regulations, emphasizing that HSAs are intended for qualified medical expenses. This approach is ethically sound and regulatorily compliant because it upholds the advisor's responsibility to provide accurate and lawful guidance. It prioritizes client education and empowers the client to make informed decisions within the established legal framework, thereby protecting both parties from potential penalties and sanctions. An incorrect approach of suggesting the client use HSA funds for non-qualified expenses, even if presented as a creative solution or a way to maximize benefits, is a direct violation of IRS rules governing HSAs. This constitutes a failure to provide competent and ethical advice, potentially exposing the client to income tax and an additional 20% penalty on the withdrawn amount, as well as jeopardizing the advisor's professional license and reputation. Another incorrect approach of simply stating that the client can use the funds for anything they want and leaving the responsibility solely on the client without providing any guidance on qualified expenses is also professionally unacceptable. While the ultimate responsibility for proper use lies with the account holder, an advisor has a duty to inform and guide clients on regulatory requirements. This passive approach fails to meet the standard of care expected of a professional advisor and could lead to unintentional noncompliance by the client. Furthermore, suggesting that the client can use HSA funds for expenses that are not directly for their own medical care, such as for a family member who is not a dependent, without clearly outlining the specific IRS definitions of qualified medical expenses and eligible individuals, is also problematic. This could lead to misinterpretation and improper use of funds, again resulting in tax liabilities and penalties. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulations. In this case, IRS Publication 502 and other HSA-related guidance. When faced with client inquiries that border on or cross into noncompliance, the advisor should 1. Clearly identify the regulatory boundaries. 2. Educate the client on these boundaries and the consequences of exceeding them. 3. Provide clear, actionable advice that aligns with regulatory requirements. 4. Document all advice given. 5. If unsure, seek clarification from regulatory bodies or legal counsel. Question 14. Market research demonstrates a significant increase in member complaints regarding extended wait times for specialist appointments within a health maintenance organization, HMO. The HMO's internal review indicates that while the number of contracted specialists meets the minimum regulatory threshold, the actual availability of appointments is becoming a concern for enrollees. What is the most appropriate course of action for the HMO to ensure compliance with regulatory requirements and ethical obligations? Option A. Focus on negotiating lower reimbursement rates with existing specialists to free up funds for potential future network expansion, without immediately addressing current wait times. Option B. Initiate a comprehensive review of the provider network's capacity and accessibility, including an analysis of appointment availability and geographic distribution of specialists, to identify and address any potential network adequacy gaps. Option C. Reiterate to members that the HMO meets the minimum contractual requirements for specialist numbers and that wait times are a common issue in healthcare. Option D. Advise members to seek care from out-of-network providers and seek reimbursement, assuming this addresses the immediate access issue. The correct answer is B. Initiate a comprehensive review of the provider network's capacity and accessibility, including an analysis of appointment availability and geographic distribution of specialists, to identify and address any potential network adequacy gaps. Explanation. This scenario presents a professional challenge because it requires an understanding of how health maintenance organizations, HMO, operate within the regulatory framework governing life and health insurance, specifically concerning network adequacy and member access to care. The challenge lies in balancing the financial viability of the HMO with its contractual and ethical obligations to provide timely and appropriate medical services to its enrollees. Misinterpreting or neglecting these obligations can lead to regulatory sanctions, loss of public trust, and harm to policyholders. The correct approach involves proactively identifying and addressing potential network deficiencies before they impact member access. This demonstrates a commitment to regulatory compliance and ethical patient care. Specifically, it requires the HMO to conduct thorough due diligence on its provider network, ensuring that the number, geographic distribution, and specialty coverage of participating physicians and facilities meet or exceed the standards set by the relevant regulatory body. This proactive stance aligns with the principle of ensuring access to care, a cornerstone of health insurance regulation. The regulatory justification stems from mandates that require HMOs to maintain adequate networks to serve their members effectively. Failure to do so can result in penalties, including fines and corrective action plans, as stipulated by insurance laws and regulations designed to protect consumers. An incorrect approach would be to dismiss member complaints about appointment wait times as isolated incidents without further investigation. This fails to acknowledge the potential systemic issues within the provider network and neglects the HMO's responsibility to monitor and ensure network adequacy. Ethically, this approach prioritizes expediency over member well-being and regulatory adherence. The regulatory failure lies in the lack of due diligence and failure to respond to potential breaches of network adequacy standards. Another incorrect approach is to focus solely on the financial cost of expanding the provider network, without adequately assessing the impact on member access. While financial prudence is important, it cannot supersede the regulatory and ethical obligation to provide sufficient access to healthcare services. This approach risks creating a network that is financially sound but functionally inadequate for members, leading to regulatory scrutiny and potential harm to enrollees. The regulatory failure here is prioritizing cost containment over the mandated provision of adequate healthcare access. Further incorrect approach would be to assume that simply having a contract with a certain number of providers guarantees network adequacy. Network adequacy is not merely a matter of contractual agreements, but also of the practical availability of services, including reasonable appointment wait times and geographic accessibility. This assumption overlooks the dynamic nature of healthcare delivery and the need for ongoing monitoring and adjustment of the provider network. The regulatory and ethical failure is a superficial understanding of network adequacy, which can lead to a gap between contractual obligations and actual member experience. The professional decision-making process for similar situations should involve a multifaceted approach. First, thoroughly understand the specific regulatory requirements for network adequacy in the relevant jurisdiction. Second, establish robust internal processes for monitoring network performance, including tracking member complaints, appointment wait times, and provider availability. Third, conduct regular audits of the provider network to identify potential gaps or deficiencies. Fourth, when issues arise, investigate them promptly and thoroughly, considering both member feedback and objective data. Finally, implement corrective actions, which may include recruiting new providers, renegotiating contracts, or implementing member assistance programs, to ensure ongoing compliance and uphold the ethical commitment to providing accessible and quality healthcare. Question 15. The review process indicates a policyholder has lodged a formal complaint regarding a denied life insurance claim, alleging that the insurer failed to adequately consider all submitted medical evidence. The insurer's initial response was to reiterate the denial based on the original assessment without further investigation. Which of the following approaches best aligns with the regulatory framework for dispute resolution in the certified professional life and health insurance (CPLHI) jurisdiction? Option A. Inform the policyholder that the initial decision is final and no further internal review will be conducted. Option B. Immediately escalate the complaint to an external dispute resolution body without conducting an internal review. Option C. Reevaluate the claim by assigning a senior claims assessor to conduct a thorough review of all submitted medical evidence and policy terms, and communicate the findings and any revised decision to the policyholder within the regulatory timeframe. Option D. Offer a nominal goodwill payment to the policyholder to close the complaint, regardless of the claim's merit. Correct answer is B. Immediately escalate the complaint to an external dispute resolution body without conducting an internal review. Explanation. The review process indicates a potential dispute arising from a life insurance policy claim. This scenario is professionally challenging because it requires balancing the insurer's obligation to process claims efficiently and fairly with the policyholder's right to a prompt and equitable resolution. The professional must navigate potential conflicts of interest, maintain confidentiality, and adhere strictly to regulatory guidelines governing dispute resolution to ensure trust and compliance. The correct approach involves initiating a formal internal dispute resolution process as mandated by the relevant regulatory framework. This process typically includes acknowledging the dispute, conducting a thorough and impartial investigation, communicating findings clearly to the policyholder, and offering a fair resolution based on the policy terms and applicable laws. This aligns with the regulatory requirement for insurers to have robust and accessible complaint handling procedures, promoting consumer protection and fair treatment. An incorrect approach would be to dismiss the policyholder's concerns without a formal review, citing internal policy limitations without proper investigation. This fails to meet the regulatory obligation to investigate all complaints and could be seen as an unfair practice, potentially leading to regulatory sanctions and reputational damage. Another incorrect approach is to offer a settlement that is clearly below the policy's value, without providing a detailed explanation of the calculation or the basis for the offer. This demonstrates a lack of transparency and could be interpreted as an attempt to exploit the policyholder's lack of understanding, violating ethical duties and regulatory expectations for fair dealing. Finally, delaying the investigation and response beyond the stipulated regulatory timeframes without valid justification is also an unacceptable approach. This not only frustrates the policyholder, but also breaches regulatory requirements for timely complaint resolution, indicating a failure in operational efficiency and commitment to consumer service. Professionals should approach such situations by first understanding the specific regulatory framework governing dispute resolution for life and health insurance in their jurisdiction. This involves familiarizing themselves with complaint handling procedures, timelines, and the principles of fair treatment and transparency. When a dispute arises, the decision-making process should involve 1. Promptly acknowledging the complaint and initiating the formal internal dispute resolution process. 2. Conducting a comprehensive and objective investigation, gathering all relevant information and policy details. 3. Communicating clearly and empathetically with the policyholder throughout the process, explaining each step and the rationale behind decisions. 4. Offering a resolution that is consistent with the policy terms, regulatory requirements, and ethical principles of fairness and good faith. 5. Documenting all interactions and decisions meticulously. Question 16. Cost-benefit analysis shows that a particular life insurance product offers a higher commission to the advisor and has a slightly higher premium than a comparable product. The client has expressed a strong preference for the higher commission product, stating they like the sound of it and have seen advertisements for it. Advisor has conducted a basic needs analysis, but has not deeply explored the client's risk tolerance or capacity for premium fluctuations. What is the most appropriate course of action for the advisor? Option A. Conduct a thorough risk assessment to determine the client's true risk tolerance and capacity for the product's features and premiums, and then recommend the most suitable product based on this assessment, even if it differs from the client's initial preference. Option B. Proceed with recommending the product the client prefers, as their stated preference is the primary driver for suitability. Option C. Recommend the higher commission product, assuming the client's preference indicates they are comfortable with any associated risks and costs. Option D. Focus on highlighting the advertised benefits of the preferred product to the client, downplaying any potential downsides to secure the sale. The correct answer is A. Conduct a thorough risk assessment to determine the client's true risk tolerance and capacity for the product's features and premiums, and then recommend the most suitable product based on this assessment, even if it differs from the client's initial preference. Explanation. This scenario is professionally challenging because it requires balancing a client's stated desire for a specific product with the advisor's fiduciary duty to ensure that product is genuinely suitable given the client's circumstances. The advisor must move beyond simply fulfilling a request to actively assessing whether the request aligns with the client's best interests and risk tolerance. This requires a deep understanding of the client's financial situation, objectives, and risk appetite, which may not be fully articulated by the client themselves. The correct approach involves a comprehensive risk assessment that goes beyond the client's initial stated preference. This means gathering detailed information about the client's financial resources, existing insurance coverage, health status, age, income, and investment objectives. The advisor must then analyze this information to determine the client's actual risk tolerance and capacity for loss. Based on this holistic assessment, the advisor can then recommend products that are not only aligned with the client's stated goals, but also appropriate for their risk profile and financial capacity. This aligns with regulatory requirements that mandate advisors act in the client's best interest and ensure suitability of recommendations, preventing misrepresentation and ensuring clients are not placed in products they cannot afford or that expose them to undue risk. Ethical principles also demand transparency and a commitment to client welfare above all else. An incorrect approach would be to solely rely on the client's stated preference without independent verification or assessment. This fails to uphold the advisor's duty of care and suitability obligations. It risks recommending a product that is too aggressive, too conservative, or financially burdensome for the client, potentially leading to financial hardship or dissatisfaction. Another incorrect approach would be to push a product based on commission potential, disregarding the client's actual needs and risk profile. This is a clear breach of ethical conduct and regulatory mandates that prohibit conflicts of interest from influencing recommendations. Finally, an approach that involves providing incomplete or misleading information about the product's risks and benefits, even if the client expressed interest, is also a failure. This undermines the principle of informed consent and can lead to the client making decisions based on a false understanding of the product. Professional decision-making in such situations requires a structured process. First, actively listen to and understand the client's stated needs and preferences. Second, conduct a thorough fact-finding process to gather all relevant information about the client's financial situation, objectives, and risk tolerance. Third, analyze this information objectively to determine the client's true needs and risk profile. Fourth, identify suitable product options that meet these identified needs and align with the client's risk tolerance. Fifth, clearly explain the features, benefits, risks, and costs of each recommended product, ensuring the client understands. Finally, document the entire process, including the client's stated preferences, the advisor's assessment, and the rationale for the final recommendation. Question 17. Assessment of an insurance professional's response when a client, who has recently experienced a significant financial loss, insists on purchasing a high-premium, complex life insurance policy with a substantial cash value component, despite the professional's initial assessment indicating the policy may not be financially suitable for the client's current circumstances. Professional has identified that the client's stated primary goal is immediate tax deferral on a recent, unexpected inheritance, a goal that may not be optimally met by this specific policy structure given the client's reduced liquidity. Option A. Advise the client to consult with a tax advisor, and then proceed with the sale if the tax advisor confirms the suitability, without further independent assessment of the policy's overall financial fit. Option B. Decline the sale, explaining to the client that the policy is not suitable based on their current financial situation and recommending alternative, more appropriate financial planning strategies. Option C. Proceed with the sale as requested by the client, emphasizing the tax deferral benefits and assuring the client that their financial advisor will confirm the suitability. Option D. Recommend a lower premium policy that offers some tax deferral, but is more aligned with the client's reduced liquidity, while also suggesting a separate, more liquid investment vehicle for the remaining inheritance. The correct answer is C. Proceed with the sale as requested by the client, emphasizing the tax deferral benefits and assuring the client that their financial advisor will confirm the suitability. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate a conflict between a client's immediate desire and the regulatory requirements designed to protect both the client and the public interest. The professional must exercise sound judgment to ensure compliance while maintaining client trust. The correct approach involves prioritizing adherence to the established regulatory framework for life and health insurance. This means understanding and applying the specific laws and guidelines governing policy issuance, disclosure, and suitability. The professional must act in a manner that upholds the integrity of the insurance process, ensuring that all actions are transparent, fair, and in accordance with the law. This approach is justified by the regulatory mandate to protect consumers from potentially harmful or unsuitable insurance products and to maintain a stable and trustworthy insurance market. Specifically, regulations often require thorough needs analysis, clear disclosure of policy features and limitations, and a determination that the product is suitable for the client's circumstances. An incorrect approach that focuses solely on fulfilling the client's stated request without due diligence fails to meet regulatory obligations. This could lead to the issuance of a policy that is not suitable for the client's financial situation, health status, or long-term needs, potentially resulting in future dissatisfaction, financial hardship, or even policy lapse. Such an approach would violate principles of client best interest and fiduciary duty, if applicable, and could expose the professional and their firm to regulatory sanctions, fines, and reputational damage. Another incorrect approach that involves misleading the client about the policy's benefits or limitations to secure a sale is a direct violation of disclosure requirements and ethical conduct. This undermines the client's ability to make an informed decision and constitutes misrepresentation, a serious regulatory offense. The professional's duty is to provide accurate and complete information, enabling the client to understand what they are purchasing. A third incorrect approach that involves circumventing established underwriting procedures or policy issuance guidelines to expedite the process, even with the client's consent, is also unacceptable. These procedures are in place to assess risk accurately and ensure the solvency of the insurer, thereby protecting all policyholders. Bypassing these steps can lead to adverse selection and financial instability for the insurance company, which ultimately impacts the entire policyholder base. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the core issue. Recognize the tension between client request and regulatory compliance. 2. Consult the relevant regulatory framework. Thoroughly review applicable laws, regulations, and company policies. 3. Assess client needs and suitability. Conduct a comprehensive analysis of the client's financial situation, health, and objectives. 4. Prioritize compliance and ethical conduct. Ensure all actions align with legal requirements and ethical standards. 5. Communicate transparently. Clearly explain to the client the regulatory constraints and the rationale behind any recommendations or limitations. 6. Seek guidance if necessary. Consult with supervisors, legal counsel, or compliance officers when faced with complex or ambiguous situations. Question 18. Upon reviewing the preliminary market research for a new comprehensive health insurance plan designed to cover chronic illness management, an insurance company is determining the most effective strategy for identifying its target audience. Which of the following approaches best aligns with regulatory expectations for responsible product marketing and consumer protection? Option A. Focusing marketing efforts exclusively on individuals within the highest income brackets, assuming they will have the greatest capacity to purchase the new plan. Option B. Relying solely on past sales performance of similar, but not identical, health insurance products to define the customer base for this new offering. Option C. Segmenting the market based on detailed demographic profiles, lifestyle indicators, and a thorough assessment of their potential need for chronic illness coverage, ensuring the product's features and price point are suitable for these identified groups. Option D. Targeting individuals based on their age and perceived health status, without in-depth analysis of their specific chronic conditions or financial circumstances. The correct answer is C. Segmenting the market based on detailed demographic profiles, lifestyle indicators, and a thorough assessment of their potential need for chronic illness coverage, ensuring the product's features and price point are suitable for these identified groups. Explanation. This scenario is professionally challenging because identifying the target market for a new life and health insurance product requires a delicate balance between business objectives and regulatory compliance. Insurers must ensure their marketing efforts are ethical, non-discriminatory, and accurately reflect the product's suitability. Failure to properly identify and target the market can lead to mis-selling, regulatory sanctions, and reputational damage. Careful judgment is required to avoid predatory practices or targeting vulnerable populations inappropriately. The correct approach involves a comprehensive analysis of demographic, psychographic, and behavioral data, coupled with a thorough understanding of the product's features and benefits, to identify segments most likely to benefit from and afford the coverage. This approach prioritizes suitability and ethical marketing, aligning with the principles of consumer protection and fair dealing inherent in insurance regulation. Specifically, it ensures that marketing is directed towards individuals for whom the product is genuinely appropriate, minimizing the risk of adverse selection and ensuring policyholders understand the coverage they are purchasing. This aligns with the regulatory expectation that insurers act in the best interests of their customers. An approach that focuses solely on high-income individuals without considering their specific needs or the product's suitability is ethically flawed and potentially discriminatory. It risks excluding individuals who might benefit from the coverage and could be seen as an attempt to maximize profit at the expense of consumer welfare. This could violate regulations, prohibiting unfair discrimination and requiring products to be suitable for the intended market. An approach that targets individuals based on broad, potentially stereotypical characteristics without deeper analysis of their actual needs or financial capacity is also problematic. This can lead to mis-selling and a failure to meet regulatory requirements for accurate product representation and suitability. It may also inadvertently target vulnerable groups who may not fully understand the product's implications. An approach that relies exclusively on historical sales data without considering evolving market dynamics or the specific features of the new product is insufficient. While historical data can be informative, it does not guarantee future success or ensure that the new product is appropriately positioned for its intended audience. This can lead to inefficient marketing spend and a failure to reach the most appropriate customer segments, potentially contravening principles of responsible product development and marketing. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the product's features, benefits, and limitations. Second, conduct thorough market research to understand potential customer segments, their needs, and their financial capacity. Third, assess the regulatory landscape to ensure compliance with all applicable laws and guidelines regarding marketing and sales. Finally, develop a target market strategy that is both commercially viable and ethically sound, prioritizing consumer protection and product suitability. Question 19. Process analysis reveals that a client, a resident of a U.S. state, is purchasing a life insurance policy from an insurer domiciled in a different U.S. state. The client inquires whether any state premium taxes are applicable to their policy. The insurance professional is aware that premium taxes are generally levied by the state of the insured's residence, but they are unsure of the exact rate and specific exemptions that might apply to this particular policy type. What is the most ethically and regulatorily sound approach for the insurance professional to take? Option A. Collect a standard premium tax rate that is commonly applied across most states, assuming it will be close enough to the correct amount. Option B. Inform the client that premium taxes are generally levied by the state of residence, and that the professional will investigate the specific rate and any applicable exemptions for their policy and state, providing an accurate estimate before policy issuance. Option C. Tell the client that premium taxes are the client's responsibility to research and pay directly to the state, and the professional will not be involved in that aspect. Option D. Advise the client that since the insurer is domiciled in a different state, no premium taxes will apply, as this is a common misconception. The correct answer is B. Inform the client that premium taxes are generally levied by the state of residence, and that the professional will investigate the specific rate and any applicable exemptions for their policy and state, providing an accurate estimate before policy issuance. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance client interests with regulatory compliance and ethical obligations concerning premium taxation. The challenge lies in navigating the complexities of tax laws that apply to insurance premiums, which can vary based on policy type, resident status, and the insurer's domicile. A professional must ensure accurate reporting and remittance of taxes without causing undue financial burden on the client, while also avoiding any misrepresentation or omission that could lead to penalties for either party. The correct approach involves accurately identifying the applicable premium tax laws for the client's specific situation and ensuring that the correct tax is collected and remitted to the relevant tax authorities. This aligns with the professional's duty to act in the client's best interest by providing accurate information and facilitating compliance, as well as the ethical obligation to uphold the law and maintain the integrity of the insurance transaction. Regulatory frameworks for life and health insurance typically mandate that insurers and their agents are responsible for understanding and adhering to tax regulations pertaining to premiums. Failure to do so can result in penalties, interest, and reputational damage. An incorrect approach of advising the client that no premium tax is applicable without a thorough understanding of the specific policy and jurisdiction would be a significant regulatory and ethical failure. This misrepresentation could lead to the client being non-compliant with tax laws, facing penalties, and potentially losing coverage if premiums are deemed insufficient due to uncollected taxes. Another incorrect approach of collecting the tax but failing to remit it to the appropriate authorities constitutes a direct violation of tax laws and a breach of fiduciary duty, potentially leading to criminal charges and severe professional sanctions. Furthermore, attempting to circumvent tax laws by structuring a policy in a way that artificially reduces the taxable premium without a legitimate business or legal purpose would be considered unethical and potentially fraudulent, violating the principle of good faith and fair dealing expected of insurance professionals. Professionals should approach such situations by first thoroughly researching the specific tax laws applicable to the type of insurance product and the client's residency. They should consult official tax guidance and, if necessary, seek advice from qualified tax professionals. Transparency with the client about any applicable taxes and the process for their collection and remittance is paramount. Maintaining accurate records of all transactions and communications is also crucial for demonstrating compliance and ethical conduct. Question 20. Performance analysis shows a significant increase in claims related to a novel, widespread respiratory illness that is impacting a large portion of the insured population across multiple geographic regions. This illness is characterized by its transmissibility and the potential for severe health outcomes affecting a broad demographic. Option A. This represents a speculative risk that the insurer can choose to accept or reject based on its investment portfolio performance. Option B. This represents a fundamental risk that requires the insurer to reassess its overall risk exposure and potentially adjust its reinsurance strategy. Option C. This represents a particular risk that can be managed by adjusting the premiums for the affected individuals only. Option D. This represents a pure risk that can be mitigated by simply increasing the marketing efforts for individual health plans. The correct answer is B. This represents a fundamental risk that requires the insurer to reassess its overall risk exposure and potentially adjust its reinsurance strategy. Explanation: this scenario is professionally challenging because it requires the insurance professional to accurately categorize risks to ensure appropriate product design, underwriting, and pricing, all within the regulatory framework governing life and health insurance. This classification can lead to financial instability for the insurer, unfair treatment of policyholders, and regulatory sanctions. Careful judgment is required to distinguish between risks that are inherent to the business and those that are external and widespread. The correct approach involves identifying the risk as fundamental. Fundamental risks are those that affect a large segment of the population or the economy, such as widespread pandemics, natural disasters, or significant economic downturns. These risks are generally beyond the control of any single individual and are typically managed by insurers through diversification, reinsurance, and robust actuarial modeling. The regulatory framework for life and health insurance emphasizes the insurer's responsibility to manage these systemic risks to maintain solvency and protect policyholders. Proper identification allows for the implementation of appropriate risk mitigation strategies mandated by regulations designed to ensure the financial soundness of insurance companies. An incorrect approach would be to classify the risk as speculative. Speculative risks involve the possibility of gain or loss, such as investing in the stock market. Insurance is designed to cover pure risks, where there is only the possibility of loss. Classifying a pure risk as speculative would be a fundamental misunderstanding of insurance principles and would lead to inappropriate product development and underwriting, potentially exposing the insurer to unmanaged liabilities and violating regulatory requirements for risk assessment. Another incorrect approach would be to classify the risk as particular. Particular risks are those that affect only an individual or a small group of individuals, such as a house fire or a car accident. While individual health events are the basis of health insurance, the scenario describes a risk that affects a broad population. Failing to recognize the widespread nature of the risk and treating it as a particular risk would lead to inadequate risk pooling and potentially insufficient reserves to cover claims, violating regulatory mandates for solvency and adequate financial provisioning. The professional decision-making process for similar situations should involve a systematic evaluation of the risk's characteristics. First, determine if the risk involves only the possibility of loss, pure risk, or also the possibility of gain, speculative risk. Then assess the scope of the risk. Does it affect an individual or a small group, particular risk? Or does it affect a large segment of the population or the economy, fundamental risk? This structured approach, guided by the principles of insurance and the specific regulatory requirements for risk management, ensures that risks are correctly identified and managed, upholding professional integrity and regulatory compliance.